Successful business owners are, well, successful, and they have three things on the mind: using their business income to support their current lifestyle, maximize retirement, and save on taxes. Yet I come across a lot of business owners that do not maximize the three. Today, we're going to talk about using retirement plans to maximize all three of these areas tax efficiently. Let's chop. Business owners have a lot on their plate. They are passionate about their businesses, so they're steadily in them. They're trying to maximize their businesses and increase their income for lifestyle income, retirement benefits, and be tax efficient about it. But with all the retirement plans out there, how do business owners select which one's best for them? And if they do have one, are they maximizing it in a tax efficient way that's going to benefit them the best? Hi, I'm Dr. Preston Cherry, founder and CEO of Concurrent Wealth Management, where we help you align your life and money to help you build and use your wealth your way. And as usual, if you like what you see, hear, and feel on this show, please like and subscribe and share the show with your friends, colleagues, and family. All right, let's chop. Business owners out there, are you using your retirement plan to the best of your business ability, or do you have one at all? And today we're going to talk about how to use your retirement planning to be tax efficient and also put more money in your pocket right now and not give so much to the government. Now, this show is going to cover some retirement plans that you may or may not have heard of, and we're going to talk about some tax efficient strategies. Now, we can't get to everything in this show because when we talk about retirement plans, wow, there's a lot of information. But we will give you some gems that you can use in your retirement plans, and you can be like Arsidio, right? For you Gen Xers out there. And also some tax strategies that you may consider year over year in order to best use the money that's coming out of your business. Now, with retirement plans, the most popular for businesses are Simple IRAs, SEP IRAs, solo 401ks, and then there's the cash balance plan. Now, cash balance plans are not talked about very often. Oh my goodness, but you can get huge amounts of money into those plans and also partner them up with 401ks. So we'll talk about them. We'll also have a whole dedicated show on cash balance plans here directly. All right, let's break down each of these plans. Now, the simple plan is the most simple along with the SEP, and these two differ in some areas. But when you're talking about setting up the simple and the SEP plans, they are the most inexpensive plans to set up. And with businesses that have good revenue and yet want to have low administrative costs, then the simple and the SEPs are generally either the first plans to go to, or you have built them up in a way to where you're ready for something else. Some firms go right with the solo 401k. However, they have a little bit more higher administrative costs. And all of these plans depend on the characteristic of your business. How many employees? Do you have any employees at all? Because the characteristics of your business is going to and the revenues that you generate and your goals are going to determine which one of these plans are best for you. The Savings Incentive Matching Plan, or Simple IRA, has some characteristics that you might be interested in. It's for businesses that have 100 or fewer employees. Now, there's a catch here, but it's also good because it's beneficial for the employer and the employee that these type of IRAs have a mandatory employer match that you must make. It's a 2% non-participant contribution or a 3% match. Now, if folks are not participating in the plan, then the employer can contribute 2%. If the employees are participating in the plan, then the employer can then match up to 3%, right? So, and here you have to be mindful of the size of your business and know that you must, as a business owner, contribute to these plans, whether the employee is participating or not. All that is good to know. Now, the simples have the lowest contribution amount, but it may fit a business's revenue. So 16,000 is the number, or as the annual contribution limit. And all these plans have contribution limits, and they also have catch-up provisions for those that are 50 or older. So if you're watching this show, most of you are Gen Xers, and you want to catch up a little bit. Remember, I say if you don't like ketchup, you need to like ketchup. So here, the annual contribution limit is $16,000 per account, along with a catch-up provision. Now, we're using 2024 numbers here because it's still tax season, and every year the contribution limits go up. They increase. So stay tuned. Always stay atop on the differing contribution limits for these accounts. So that is the simple in the most simplest terms. The next up to bat is a SEP IRA. And a SEP IRA has employer-only contributions. Remember when I said that the characteristic of your business is going to determine which one of these plans that you want to set up. Not only the characteristics of your business, but the revenue streams and your goals are going to allow you to analyze which one of these plans are best for you. So for the SEP, they are only allowed employer contributions. So no employee contributions. And the employer contributions are optional in this regard. So with a SEP plan, you have a little bit more flexibility on whether or not you want to, as a business owner, contribute to the employee retirement plan. Now, the employees here, by nature of employer only, are not able to contribute to these plans. And with contributions being employer only, it could reduce the rate of speed an employee can build up a sizable retirement account. That said, there's always something on the table. So an employee, as far as retention is concerned, to say, okay, at least you have something that I can participate in. And far as the SEPs IRAs for the owners can go, these contributions amounts or contribution limits are a lot higher. So for 2024, $69,000 that you could contribute to these areas. And remember, for employers, you business owners out there, the contributions that you make to SEPs, Simples, solo 401ks, and cash balance plans are all tax deductible. So when we talk about your retirement plan being maximized, your tax efficiency being increased to the hilt, and also keeping money in your pocket, retirement planning using your business is the most beneficial to all three of those areas. So that's why retirement planning with your business is so essential. Now, the third option is the solo 401k. Wow, this is a gem, right? Solo 401ks are for, as the title talks about, solo business owners, so no employees. And there's a special caveat with solo 401ks. Even though that you don't have employees, your spouse can take advantage of the solo 401k as well. So in 2024, you have $69,000 going into the plan as elective tax deferrals, and then after tax contributions up to $69,000. Well, your spouse can do the same thing and essentially double these amounts. Wow, that is something that you can look forward to and get almost $140,000 into a plan, and even with catch-ups, it can be $150,000 plus. Oh my goodness. An owner and spouse utilizing a solo 401k. A solo 401k has a little bit more cost attached to them as far as to run. That said, the return on your investment is phenomenal. So don't let the cost tail wag the dog. If you're a solo practitioner with no employees, a solo 401k is a great way to go, considering the characteristics of your business and revenue flow, right? You can also use a solo 401k in order to orchestrate a mega backdoor Roth. So meaning when you contribute your high amounts to your solo 401ks, you're doing so in a pre-tax manner, getting tax deductions up front, your assets growing tax deferred. If you want to diversify your lifetime tax rate, then using Roth conversions over your lifetime and even early parts of retirement, laddering these Roth conversions over time, you can use the large amounts in your solo 401k and do Roth conversions in a mega backdoor way. So what do we mean by mega backdoor Roths? Well, we'll have a show on this later on, but Roth IRAs have after-tax contributions, tax deferral in the middle, and then when you distribute, it's tax-free. Whereas 401ks, you contribute tax pre-tax, have tax deferral in the middle, and then are taxable on the distributions. Well, Roth IRAs are sweet, right? Everybody would have one. Yet, Roth IRAs have income limits as far as participation is concerned. If you make over the income limits, then you can't participate in a Roth IRA. However, you can contribute to traditional IRAs or your solo 401ks, or if you're at a big corporation, your 401k, and transfer those amounts into Roth IRAs. You have to pay tax upon the conversion immediately in order to transform pre-tax dollars into after-tax dollars. That's why folks have to have a lump sum amount every time they make a conversion from pre-tax into a Roth IRA. And the mega part of it is because you can contribute so much money into the 401ks in the first place. Now, as I said, we're going to have another show about how to do these Roth conversions and what to be mindful for. Essentially, the pro rata rule, which can, if you do these conversions in a incorrect manner, it could trigger some tax and it could trigger larger amount of tax that you didn't expect. All right. Solo 401ks, consider those. Let's talk about cash balance plans. Cash balance plans are a hybrid defined benefit and defined contribution plan with high contribution amounts. So you can get $380,000 into a cash balance plan and have it be tax deductible above the line. So you have a 1040, right? And you have your reportable income. Well, and then you have your deductions, and then it reaches your adjustable gross income. Well, when you have those above the line, above the AGI deductions, it reduces your income amount that's susceptible to tax. The above the line tax deductions are golden. So when you're talking about a cash balance plan, when you're making contributions to these plans, you have the above the line deduction, reducing your overall income exposure to tax. And the contribution of the limits of a cash balance plan is $380,000. Woo-wee, right? That is a lot of money. And you can partner a cash balance plan with a solo 401k, essentially getting almost $500,000 per year into your retirement plans. That's what we're talking about by using your business revenues to support your lifestyle now, because money that you weren't contributing to your retirement plan is not deductible and raises your income amounts, and that money is going to tax obligations. So if you make contributions to your retirement plans, you're paying your current and future self, because those contributions are going to your future self. They're tax deductible, and monies that are otherwise that would have been gone to the government, all right, then they're going back in your pocket to support your lifestyle now. All of these plans, so depending on your revenue situation, your goals, and the characteristics of your company, will determine which one of these that you select. Simple IRA, SEP, solo 401k, and a cash balance plan. All right. Now, when we're talking about your retirement accounts, there's some other tax strategies that you could use your business to orchestrate. We've been talking about Roth conversions. Roth conversions smooth out your tax rate over time, because as you're a high income earner right now, you're in the highest tax brackets. Now, you're probably going to maintain either a high tax bracket or a slightly reduced tax bracket in retirement. That said, in retirement, you want diversified retirement income streams when it comes to tax. You want pre-tax retirement plans that are exposed to ordinary income upon distribution, or you want after-tax contributions that are not taxed upon distribution, and that gives you a blended rate. Now, both of those roadmaps have tax deferral in the middle. Okay. And then you also have your taxable brokerage accounts, which do not have any tax deferred benefits, except that when they have no limits when you contribute to a taxable brokerage account. You also have a lot more flexibility to the access of your brokerage accounts, meaning you don't have to be 59 and a half. There's no penalties. And then if you hold on to your investments for a year or longer, then you're not paying ordinary income tax. You're paying long-term gain tax. All right. So you want to have a diversified tax rate over your lifetime where you're paying tax on distributions and not paying tax on distributions during retirement. Okay. So Roth conversions can be helpful in lower income earning years where you can make those contributions, or in down stock markets, right? Where you can make those conversions. You have to pay the tax right then. However, you can pay lower tax amounts during those two scenarios. All right. HSA accounts are very important. Health savings account, triple tax advantage, gives you an above the line contribution. And you can also use HSAs for retirement. So HSAs, you're not having use it or lose it like flexible spending accounts. You contribute dollars pre-tax, you get tax deferred growth, and no tax on distributions if they're used for qualified medical expenses. Now, if these amounts grow over time and you're not using for qualified medical expenses, you can use these amounts in the accounts however you like for QMEs, qualified medical expenses. But when you reach age 65, you can make a withdrawal out of an HSA without penalty and not paying for QME. So meaning you can subsidize your retirement income streams with an HSA going all the way forward during your retirement plans without penalty after age 65. All right. And lastly, I would say diversify your accounts. So taxable brokerage, IRAs, 401ks. The main thing is diversifying those ordinary tax exposure and no tax exposure in a blended lower lifetime tax rate over time by diversifying your accounts and the growth and distribution tax rates over time. All right. Looks like we went to school, right? Now, all the information that we discussed is not tax advice or investment advice, but these are a bunch of insights that you can consider in order to use your successful business to thrive now and thrive later. All right. That's what I got for you. If you like what you've seen, heard, and feel on the show, please hit that like and subscribe button and share with your family, friends, and colleagues. And until next time, we'll talk soon. Cheers.